Good morning, today is Friday, February 20th, 2026. We are analysing a volatile week for the Indian markets as the Nifty 50 faces significant pressure. The benchmark Nifty 50 index recently experienced its sharpest intraday decline since the Union Budget, falling 1.41% to settle at 25,454.35. This move has rattled investors as the index breached multiple short-term support levels during the session, driven by heavy profit booking across key heavyweight sectors. Looking at the gift Nifty trends, we saw some resilience earlier in the week, but global signals have turned mixed as we approach the final trading session of the week. Global sentiments are currently weighed down by a correction in the US Nasdaq and mixed performance across Asian markets, particularly in the tech and banking segments. Geopolitical uncertainty has surged following escalating tensions between the United States and Iran, leading to a flight towards safety and pressure on emerging market equities. Crude oil prices have spiked as a result of these tensions, posing a direct threat to India's fiscal deficit and adding inflationary pressure to the domestic economy. The India VIX, or the fear gauge, has surged over 10% to reach near the 13.50 level, reflecting heightened investor anxiety and increased volatility expectations. A rising VIX often correlates with market sell-offs. For derivatives traders, this translates to higher option premiums, making hedging more expensive in the current environment. On the technical front, 25,454 is now the critical immediate support level that the bulls must defend to prevent further downside. Should this level fail, the next major support zone is seen around 25,200, where we expect to see significant value buying from long-term investors. On the upside, 25,750 remains a formidable hurdle. A decisive close above this level is required to regain bullish momentum. The psychological mark of 26,000 continues to be a major objective for the bulls, but current global headwinds make a breakout challenging in the short term. The Reserve Bank of India recently maintained the repo rate at 5.25%, keeping a neutral stance while monitoring inflation and growth dynamics. While the decision was largely expected, it offered no fresh triggers for the market, leading to a neutral reaction in rate-sensitive sectors like banking and auto. Despite the volatility, India's economic foundation remains strong. GDP growth for the fiscal year 2026 is projected to be around 6.9%. This growth is fueled by sustained momentum in domestic consumption and a significant uptick in private sector investment across major industrial hubs. Let us delve deeper into the technical indicators, which are currently providing mixed signals about the market's internal strength and momentum. The 14-day relative strength index is currently at 29.687, suggesting that the index is in oversold territory and could see a technical bounce. However, the moving average convergence divergence, or MACD, continues to show a bearish crossover, indicating that selling pressure remains dominant on higher levels. The index is currently trading below its 50-day moving average, but it remains comfortably above its 200-day moving average, which is a critical long-term bullish trend line. For a sustainable recovery, the Nifty 50 needs to cross and hold above its 50-day moving average, which currently sits as a dynamic resistance level. Institutional activity has been a key factor lately. We have seen persistent outflows from foreign institutional investors, driven by rising US yields and geopolitical concerns. Crucially, domestic institutional investors have been the backbone of the market, absorbing much of the FII selling pressure and preventing a complete market collapse. Strong SIP inflows and robust participation from retail investors continue to provide a steady stream of liquidity to the domestic markets. Looking at the sectors, the IT index has been a major laggard. Concerns over global demand and corrections in US tech stocks have heavily impacted Indian IT majors. The banking sector has also seen significant profit booking. While fundamentals remain strong, the lack of immediate triggers after the RBI policy has led to some consolidation. The FMCG sector is showing some defensive strength. Investors are moving toward consumption-oriented stocks as a hedge against the ongoing volatility in high-beta sectors. In the energy space, Reliance Industries remains a key stock to watch. Its performance will be critical in determining the index's ability to hold its current support levels. For intraday traders, we recommend looking for momentum stocks that are showing high volume breakouts above their previous day's highs during early trade. Focus on stocks that are trading above their VWAP and showing an RSI between 60 and 70, which often indicates strong bullish momentum for short-term gains. Moving forward, the three sectors to watch closely are FMCG for its defensive qualities, energy for its growth potential, and the defense sector for policy support. The FMCG sector acts as a safe haven during periods of high volatility, as demand for essential goods remains relatively inelastic to broader market fluctuations. The defense sector continues to benefit from the Make in India initiative and increasing export orders, providing long-term visibility for major industry players. The way forward for the Indian markets in 2026 will depend on how we navigate these global headwinds while maintaining our domestic growth momentum. Corporate earnings recovery remains the most crucial factor. We need to see robust earnings growth to justify the current market valuations and support a sustained rally. Monitoring headline inflation will be essential, as analysts forecast a slight rise to 3.9% year-on-year, nearing the RBI's target of 4%. However, investors must remain vigilant of the risks. Geopolitical tensions in the Middle East and a further spike in crude oil prices could lead to more volatility. Valuation concerns persist as the Nifty 50 maintains a premium over other emerging markets, making it sensitive to any negative surprises on the macroeconomic front. Our expert advice is to maintain a diversified portfolio, avoid overconcentration in high beta sectors, and consider increasing allocation to large-cap quality stocks. To summarize, keep a close watch on the 25,454 level. A break below this could lead to a deeper correction toward 25,200. Despite short-term volatility, the long-term structural story of India remains intact, with the economy projected to be a major global growth engine for the next decade. Stay disciplined with your investments and continue to follow our deep dive analysis for the latest updates on the Indian markets and global trends. Thank you for watching our Nifty Outlook for February 20th, 2026. We wish you a successful and profitable trading session ahead.